Hello, today we are going to discuss about the AS11, the effects of changes in the foreign exchange rate. See, as in a globalization, the import and export has been increased, and for that purpose, how that transaction will be recorded in the books of account, that we are going to be discussed. So the AS11, the effect of changes in foreign exchange rate, this standard deals with the issue involved in the foreign currency transaction and foreign operation. It means the when there is the import is there, import purchase is there, export sales is there, then that time the currency we are using the currency of the different countries. Say as the buyer is or importer from the India and exporter from the USA, then in that case the dollar currency we are using that. And the foreign operations also there where there are the head office and the branches are located into different countries, then the foreign operation transaction has been incurred. It decide about the use of the exchange rate and to recognize the financial effects of the changes in exchange rate in the financial statement. It means the when we are making the payment towards the import or the we are receiving the payment towards the export sales, that time we have to follow the foreign exchange rate. So the day on which we are purchasing or importing the goods and the day on which we are making the payments, that time the rate of exchange is different. So we have to make the payment according to that. The effect of the changes in foreign exchange rate where the applicability of the AS11, this transaction in the foreign currencies first, then foreign operation, forward exchange contract. So in the three cases it is applicable, and it is not applicable when there is a specify in the currency in which the enterprise is presented in FS, cash flows arising from the transaction in the foreign currencies, then exchange difference arising from the borrowing, adjustment of interest cost, restatement into other currency for the convenience of users. So this is the non-applicability and applicability to the AS11. First we'll discuss about the foreign currency transaction. So foreign currency transaction is a transaction which is determined in a required settlement in a foreign currency, including the transaction arising when an enterprise is either buy or sell the goods or services whose price is determined in foreign currency. So as I've given the example that import and export is there, then the borrowers or lends of funds. So we know that the people or the businessmen, they are purchasing the loan or they are taking the loans or borrowing the loans from the foreign currency, same they are lending the loans to the foreign country. So thus such type of the transactions will be there. Then the it becomes a party to an unperformed forward exchange contract. So we'll discuss the forward exchange contract also, and it acquires or disposal of the assets or incurs in settlement of the liabilities denominated in a foreign currencies. Here we have to discuss the two items, that is the monetary items. Monetary items are money held and assets and liability to be received or paid in fixed or the determinable amounts of the money. Example, cash, receivable and payables. And non-monetary items are asset and liabilities other than the monetary items. Example, fixed asset, inventories and the investment in equity shares. So further accounting treatment, initial recognition. See, when the foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount and exchange the rate between the reporting currency and the foreign currency at the date of the transaction. It means as and when we are purchasing, that time the purchase transaction will be recorded in the books of account, and that time the when we are importing the goods from the foreign country, but obviously we have to follow the exchange rate which is prevailing in the on that particular date. So according to that the transaction is recorded into the books of account, then reporting at each balance sheet date. So here monetary and non-monetary transaction or items are there. So when the monetary is there, when there is a reported during the closing date, and in the case of the non-monetary date, the carried in terms of the historical cost in a foreign currency, the reported using the exchange rate at the date of the transaction, then carried at a fair value of other similar valuation denominated in the foreign currency, that time the reported using the exchange rate that existed when the values were determined, and contingent liability denominated in foreign country disclosed by using the closing date. So here what I want to tell you that key monetary and non-monetary items are there. On that basis we have to make the treatment in the books of account. Recognition of exchange difference. So exchange differences arising on the settlement of the monetary items at a rate so different that would those at which they were initially monitored or recorded during the period or reported in previous financial statement. It should be recognized as an income or expenses in the period in which they arise. That is the first one. Second, exchange difference result, where there is a change in the exchange rate between the transaction date and date of settlement of any monetary items arising from the foreign currency transaction. It transfer from the foreign exchange difference account, as foreign exchange different account is a nominal account, and balance transfer to the PN account. As if you see that, we'll just go through that. Suppose here I just give you an example. Suppose uh, import purchase is there, import purchase from USA, okay, and the amount in US dollar, that is 10,000, okay, and date is say as 15th for 2025, okay. Now if you want to record this transaction in the books of account, then how you are going to be record the transaction? Here the import purchase will be there, that will be debited, import purchase account debit to creditors account, okay. Here the calculation will be $10,000 is there, and one more thing I just want to put before it, exchange rate that is a for the per dollar is equal to rupees 60. Then the transaction will be recorded that $10,000 are there and multiply by 60, so the amount will be 6 lakhs will be there recorded in Indian currency. It means rupees 6 lakhs will be 6 will be recorded into the books of account. So such type of the entry has been passed there. Now when we are making the payment, suppose the payment has been made, payment to creditors on 30th April 2025, and that time the exchange rate was say as 60 rupees. Now in this case when we are passing the entry, this first entry has been passed on 15th April 2025. Now second entry we are passing, that is the payment entry, the date is 30th April 2025. Now we are making the payment to creditors account, debit is there, okay, that is $10,000 are there at the rate of 60. So here the 10,000 into 60 was there, so that is a 6 lakhs. Now the payment we are making that, so here the to bank, okay. Now when we are making the payment, that time the exchange rate was 62, so we are making the payment of rupees 6 lakhs 20,000. Now there is a difference which has been arise when we purchase the goods, that time the exchange rate was 60, and when we are making the payment, that time the exchange rate is 62. It means there is a 2 rupees increase in the exchange rate, and here we are making the payment, so we are paying more to the creditors, so henceforth it is a loss to us, okay. So that loss will be transferred to the foreign exchange difference account. So there is one more account we have to prepare, that foreign exchange difference account, or else we call it as a foreign exchange fluctuation account also. So that amount will be 10,000 into 2 rupees per dollar, so that is 20,000. So like that the difference will be transferred to the foreign exchange account, and ultimately the foreign exchange difference account will be transferred to the PN account. So here foreign exchange difference account is there, it is nominal account and balance transfer to the PN account. When the transaction is settled within the same accounting period in which it occurred, all the exchange difference is recognized in that particular period. We will see in the sums also. When the transaction is settled in a subsequent accounting period, exchange difference recognized in each intervening period up to the period of settlement is determine the change in the exchange rate during the period. So when we are closing our books of account, that time we have to record the transactions. Exchange differences arising on the reporting of the long-term foreign currency monetary items on rates different from those at which they were initially recorded during the period or reported in previous financial statement. So insofar as they relate to the acquisition, the depreciable capital asset can be added or deducted from the cost of the asset and should be depreciated over the balance life of the asset. So here we will discuss one sum which is related to the purchase of the asset. That time we'll discuss that. And in any other case can be accumulated in the foreign currency monetary items transaction between the translation difference account. Okay. Now we will discuss one sum. The sum is that following is the details of the import purchase. Okay, so here uh, goods purchase on 1/1/2017 for US dollars 15,000. That time the exchange rate was 75. Okay, again the exchange rate on 31st March 2017 is given, that is 74. Then date of the actual payment, that is 7th July 2017, and the exchange rate was on a 73 per dollar. You are required to ascertain the loss or gain or for financial year 2016-17 and 2017-18. Also give you their treatment as per the AS 11. So here we have to record the transaction for the 2 years. So we'll see the one by one. First transaction is there, goods purchase for 15,000 US dollar at the rate of 75. So here see in the books of dash journal entries, the first entry is that 1/1/2017, that is for the financial year 2016-17. Okay, okay, this is the financial year because they have asked the question gain or loss for the 2 years. So 1/1/2017, okay, the entry will be was import purchase account debit to creditors account, creditors account. Now here the total $15,000 is there. So $15,000 is there. So I just make the calculation here, right? $15,000. Okay, and the exchange rate was in a 75 on that particular date. 75. So $15,000 into 75, 15,000 into 75. So there is an 11,25,000 is their amount. First entry which is an import purchase. Then the payment which has been made on the 7th July, it means in the next financial year. But before that we have to pass the closing entry on 31st March 2017. So on 31st March 2017, we are not making the payment to the worst creditors, but we have to give the effect of the closing exchange rate in the financial year 2016-17, which is then 74. So here the difference we have to check out that the rate was at a 75, okay, and now the rate is at a 74. It means the rate has been decreased 75 to 74. The rate has been decreased 75 to 75 to 74. Okay, by rupees 1 rupees. It means here as an rate has been decreased, it means there is a gain to us. So therefore foreign exchange fluctuation account is credited. See, foreign exchange fluctuation account is a nominal account. So we know the rules of the nominal account, that debit all expense and losses, credit all income and gains. So hence for that creditors account debit, creditors account debit to foreign exchange difference account. Okay, foreign exchange difference account, and the amount will be, that is according to that $15,000 is there at the rate of 1 rupees. Okay, so 15,000 is an amount is there. So 15,000 amount. Okay. Now there is a gain in the foreign exchange difference account which is credited. Now that will be transferred to the PL account. So 31st March 2017 we will pass the entry, that is in a gain will be transferred to the PL account to foreign exchange difference account debit to PL account. This entry, it means we are transferring the gain in the foreign exchange difference account to the PL account. As in it is a nominal account, so we are transferring the PL account. Okay. This is the journal entries for the 2016-17 first part. Now second part 2017-18. Okay. Now date of actual payment 7/7/2017 by rupees 73 per dollar. So we are making the payment to creditors account, will debit will be there. Okay, the date is in a 7/7/2017. Okay, 7/7 to the creditors account debit. Now see, previously the balance of the creditors was in a 1,12,500. Sorry, 11,25,000. Okay, that is in a at the rate of this 75. Okay, for the $15,000. Okay, now there is a debit item is 15,000. It means that is a we have deducted 1 rupees. Now the rate is in a 74 for the creditors. So that is in a 111 11,10,000 is an amount is there. Okay, so 11,10,000 is their creditors amount. Okay, how it is calculated? See, when we purchase the goods, that time the creditors for dollar rupees 15,000, that time the exchange rate was 75. When we close the books account, that time the exchange rate has been decreased to 74 by rupees 1. So that amount has been recorded into the creditors account by debiting. Now we have to make the payment to the creditors according to the balance which is reflected in the creditors. Okay, that is in a 11,10,000. Now we have to make the payment to bank. Okay, now we are making the payment. See here, at the time of the payment the exchange rate is in a 73. Okay, so here we are to make the payment at the rate of rupees 73. So 15,000 is there and the rate is 73 per dollar. So amount is in a 15,000 into 73, 10,95,000. So we are going to be make the payment 10,95,000. Okay, now see, the exchange rate was in a 74 and we are making the payment at the rate of rupees 73. It means again the 1 rupees gain is there, which is transferred to the foreign exchange difference account. Okay, so 1 rupees gain is there, transferred to the foreign exchange difference account. Okay, that is in a 15,000 into 1, that is a 15,000. No, hence this general entries have been tallied. Okay, if you see, I just make the calculation here, so you will be able to understand that. See, that is enough 15,000 into 75. Okay, difference is enough 15,000 into 1. Okay, here creditors, the balance was enough 15,000 at the rate of 74. We made the payment 15,000 at the rate of 73. Okay, and here 15,000 into 1 rupees transfer to the, like that this adjustment has been done. Now again there is a credit foreign exchange difference by 15,000. Now there is no further entries or the transaction has been given. So henceforth we close the books of account, and on 31st March 2017, okay, 31st March 2017, the foreign exchange difference account balance will be transferred to the PN account. So entry will be, as an it is credited, so we will debit the foreign exchange difference account, okay, by rupees 15,000. Rupees 15,000. Okay, it means here what we did that, here if you see that, here import purchase is there. Okay, to creditors 15,000 per dollar at rate of 75 First we record a transaction, okay, at the rate of 75 per dollar. Then as an we are going to make the payment in the subsequent financial year. Henceforth, and on 31st March 2017, whatever the foreign exchange rate is prevailing, according to that we have to give the effect in our books of account. Okay, so if the foreign exchange different account is reflecting the gain, it will be credited. If it is reflecting the loss, it will be debited. Okay, so here the there is a gain is reflecting, so the gain has been credited and the creditor's account has been debited by rupees 15,000. It means the foreign exchange difference is in a 15,000 transfer to the PL account. See, in the question they ask that you are required to ascertain the loss on gain in the financial year. So there is a gain is there for rupees 15,000 in the financial year 2016-17. Then further for the 2017-18, we are making the payment on 7 July 2017. So creditors account debit is in a 15,000 at the rate of 75, because we recorded the transaction by 75, then creditors has been debited by 1, so 74, and we are making the payment for $15,000 at the rate of 73. That it exchange rate is 73, so that comes to 10 lakh 95,000. Again, there is a gain in the foreign exchange, so therefore the amount has been transferred to the foreign exchange difference account. Okay, so $15,000 multiplied by 1, so 15,000 is there, and they have not provided any information regarding that, so we directly close the books of account and the foreign exchange difference account has been transferred to the PL account. It means the balance of the foreign exchange difference account has been transferred to the PL account. That is the final entry. So total gain which has been arise from this transaction from the 2016-17 15,000 and 2017-18 also 15,000. Okay, so this is the way we have to record the transaction in the books of account. Okay, see here, if further if you I just want to relook at again the point number 2. See, the exchange difference result when there is a change in the exchange rate between the transactions, change in the exchange rate between the transaction date and the date of settlement. Now in creditors, when we are making the payment of the credit payment towards creditors, it is a settlement. So the day on which the transaction recorded as in a purchase transaction and a settlement, okay, of any monetary items arising from the foreign currency transaction, then it transfer to the foreign exchange difference account. So we have to transfer the difference to the foreign exchange difference account, or else there is the foreign exchange fluctuation account is also there. As I told you, it is a nominal account, and the balance transferred to the PL account. It means whatever the balance will be there throughout the year in the foreign exchange difference account will be at the end of the year will be transferred to the PL account. Okay, so according to that we have to record the transaction in our books of account. Okay, so thank you.